So the use of factor analysis is integral to our process at this point. And there's two main ways that we would use factor analysis. The first is really attempting to validate the manager's philosophy and process. And the second is performing factor-based performance attribution, in addition and supplementing our traditional Brinson selection sector attribution. So the first part, validating the manager's philosophy and process, as I mentioned, we would load these holdings into various tools like a Style Analytics, and then we would attempt to reconcile what we're seeing from an exposure standpoint to the manager's stated philosophy and process. So to bring it to life with an example, if we're doing a deep dive on a deep value manager, we would expect statistically significant exposures to most, if not all, value factors. And then hopefully that would reconcile with that manager's philosophy and process. Conversely, or the other side of the spectrum, if we were looking at a high-octane momentum growth manager, we would expect significant exposures to things like price momentum, earnings growth, sales growth, revisions, and hopefully we would see that come through in the numbers, again, from a statistically significant standpoint. Other examples might looking at quality managers, where we would look, is there an exposure to accruals or low leverage, high ROE, high ROIC, and hopefully there's a reconciliation there. And maybe finally, one last example, if we were looking at a low volatility conservative equity manager, what does a tool like Style Analytics or Barra tell us in terms of the risk profile? Is there in fact kind of lower beta, lower volatility in that manager's stylistic footprint? From an attribution standpoint, we would look at it through a couple ways. So for example, we're currently looking at an international small cap value manager that has a contrarian bent to them, so you'd expect negative momentum type characteristics. How is momentum done over the last 5 years in that space? It's done well, so you'd expect that to flow through the data. Importantly, when we're doing factor attribution, we're also looking at the sources of return from a common factor perspective and a selection perspective. Ideally, we're seeing most of the manager's alpha or excess returns and risks coming from selection and not common factors. If we did see the reverse, where most of the excess return and most of the risk was coming from common factors, that would cause us to kind of take a closer look at that manager. It might suggest that these common factors should be cheaply available and one should not be paying active management fees for that type of strategy. Often in looking at the results, they're not always intuitive, and there's an iterative process where we go back and forth with the manager to better understand the results. We're not blindly following risk models or factors, and we're also not blindly following the manager, but hopefully the two do reconcile. But oftentimes we are going back to the manager. So for example, in recent history, to continue the deep value analogy, you see a lot of structural exposure to risk for these deep value managers, despite the manager not specifically targeting that exposure. And in discussions with those managers, you'll see that since the global financial crisis, yes, there's been a high correlation between deep value and risk and beta, but that has not always been the case. So for example, the popping of the TMT bubble in the late 90s, early 2000, risk actually was negatively correlated with deep value, and deep value was actually a flight to safety space. So it is an iterative process. We don't blindly follow these models, and it's important to work with the manager to understand where there might be discrepancies. So once we've done a lot of this factor work, ultimately a decision is made to proceed or not proceed. And ultimately, we would likely proceed if we can really understand the manager's philosophy and process. What market anomaly are they trying to take advantage of? Is there an edge with that manager? And can we reconcile the quantitative results with our subjective, qualitative, judgmental view?